All right, in today's video, I want to talk about Sberbank of Russia. In a way, it's an extension of the video I did yesterday on Yanzhou coal mining, in that it's a very low PE stock that pays a dividend yield. And with my style of investing, I really hunt for these type of equities. It's something I do a lot of different screens for. I look at other type of value screens. And so this is something I actually purchased it in, I want to say September of 2018. I'll show that in a second. But the first thing here I just wanted to show you is it is a Super-Maneosian. So its dividend yield is 11.24%. Price to earnings is 6.67%. Just to refresh, and it's actually in the text on this video, you'll see at the bottom after my quotations. A Super-Maneosian is where the dividend yield is greater than the price to earnings. A Maneosian is where the ratio of the price to earnings and the dividend yield is equal to or less than 2. So, for example, if the PE were 11.24 and the dividend yield was 6, it would be a Maneosian, but not a Super-Maneosian. Now, with these metrics that I've created, it doesn't necessarily mean that you should go out and buy every Super-Maneosian, every Maneosian. They're just metrics to show that something is unloved and something's going on there. Now, maybe it's unloved for a good reason, whether the business itself, geopolitically, maybe, for example, the business is borrowing a bunch of money to keep the dividend, to pay out the dividend. So there are a lot of things that could be going on, but I just like to look at these things. It's a starting point for me, and then I can do more due diligence. But yeah, so you can see, dividend yield. You can see here, it was trading even in 10/22/2020 at 10.90. It looks like it's in 17.18s now. Let's just scroll down here. You can kind of see what some analysts are saying about it. You see this guy in January is neutral. January neutral, bullish, December of 2020, October of 2020. So you can see also this isn't a highly covered stock like some of the others on Seeking Alpha that get a lot of attention. You can see like a lot of people were bullish on it. This guy in September of 2020, Alexei Ragdolgin, looks like he's Russian, very bullish, not just bullish, very bullish. He also wrote another article, May of 2020, very bullish. So we can go here now to, this is on Y charts. You're going to kind of get the same information. Price to earnings 6.7, dividend yield here 11.09. So it's very similar. And then we're going to go to fast graphs here. So again, you're seeing here, it's showing here the dividend yield. This is of 831 as 7.12. Its normal P ratio is 9.33. The intrinsic value has it at 15. Look at its earnings yield, a blended adjusted earnings yield, 14.31. Chuck Carnival, the founder of Fast Graphs, like 6.5. And so you see here, this is more than double that. You see a dividend yield of, here it's a little bit different. They're showing a dividend yield of 9.2 versus 11. But regardless, if you're showing, well, this one wouldn't be a Super-Maneosian if that's normal. Oh, that's normal PE, not blended PE. So if it's even if its dividend yield is an 11, if it's 9, it's still a Super-Maneosian because it's showing a PE of 7.12. So yeah, look, it's not to the extreme margin of safety that Yanzhou coal mining had, but there's certainly a margin of safety. And for those of you who look back at the previous video and you look at something like Apple, it's the other way. You'll see the black line up here, orange and blue line here. So it's just something to look at. And I feel that there's always value to be had. You just maybe need to search outside of your country in different markets, do different screens. But For me, I generally allocate capital every month from my option strategy and from dollar cost averaging. Some months that's $2,000 or so. Some months that's $10,000 or $12,000. It just depends. And so I'm always hunting for value like this. You can see my return here. You can see my purchase was September 21st, 2018, $11.83. It's now showing at $17.97. You can see a dividend came off here. I made another purchase. Actually, it went down in 2020. I made another purchase, 64 shares, October 19th of 2020, 1050. You can see that return has been about a 70% return. Then you're going to see some dividend yields coming off. 11/26 of 21. I got $100 dividend, which is tremendous. And that $100 is now $103. So that was just June of this year. But so you can see that the return is showing is 56.94. It's a lot higher than that from a total return perspective. I would just take, we can actually do it here just to get it, to give you a sense. So 5.9, the way we do this is we're going to do what my actual cost basis is. Because my dividends to me aren't a cost basis. 591.95, 673.83. So we're at 1265.78, and the value today is 2276.56. So we're going to take 2276 divided by 1265 minus 1. So we're looking at a 79.9% return. So we're looking at basically an 80% return. So you can see that Yanzhou coal mining it was a shorter time frame. It was a more recent purchase, 80% return. 68% return. Sberbank of Russia, 80% return. Now look, we're in a bull market, but the way you got to look at it, the way I look at it, at least the way that it informs my investing is, okay, so I'm looking at Sberbank of Russia here, right? And it's trading at a 6.67 PE. So what happens in a market crash? Well, if it falls. So now its dividend yield is going to go to 14% and its price to earnings is going to go to 3 or 2 or 1. I'll be happy to own Sberbank at 1 or 2 times earnings. And especially with the high dividend yield, because it's going to basically create forced buying by reinvesting my dividends. And it actually makes me think of Jeremy Siegel, professor at Wharton. His book is behind me. I can just grab it. Why not? Let's just grab it here. So there we go. It's right over here. Stocks for the Long Run, Jeremy Siegel. And in this book, he talks about how Philip Morris was the best performing stock over the last 50 years or so. And the reason being is that because of the negative press, tobacco is going to be banned, or tobacco causes cancer, tobacco this, tobacco that, they're ripping out fields. It was consistently an undervalued stock, but it wasn't just an undervalued stock. It was an undervalued stock that had a fairly high dividend yield, 3, 4, 5%. And so when you were reinvesting your dividends, you were consistently buying an undervalued stock. And so the same could be said for something like Sberbank. If we go into, we had the great panic of March of 2020, 2022, 2023. Okay, so it's going to fall. What's it trading at? $18. It falls to $10, $9, goes down 50%. Even if they cut the dividend might go to 14%. Naturally, they might cut it back down to 11, or they might cut it to 6, or but the P is going to be 3. So again, there's that margin of safety. It goes back to Monish Pabry's sensibility. Heads I win, tails I don't lose much. That's how I look at these things. So it's a different philosophy than growth investing, glamour investing. looking to buy things, that are trading at massive valuations on the hope that they're going to trade at even more massive valuations. And that's momentum that certainly can happen. But I like the intrinsic value, the dividend style of investing. It just suits my temperament. And also I would say this, I'm already a multimillionaire. If I were starting out and hungry to get rich quick, or to pivot myself up to make one big score, one big play, like a gambler in a casino, or a real estate speculator looking to buy a house in a foreclosure that is going to make him X, 3X, 4X, 5X, to really pivot up in life. But part of what I'm doing is defense as much as offense. It's that delicate balance between defense and offense. And Howard Marks talks about that in his book that I just finished as well. I'm not at Howard Marks's level as far as wealth. I think he's worth like $2.2 billion. I'm only worth a couple $1 million. So it's not on that level. But still, part of my strategy is to preserve capital, not just multiply. That's a big portion, but I also think of defense as well. So anyways, that's just a little information on Sberbank. And again, as you see in the disclaimer, I'm not a financial advisor. I don't manage outside capital. This is an entertainment show, and this is a show where you can see someone who's investing on a high level, the decisions I'm making, and if those decisions are foolish or wise. So you can say, well, this guy, he shouldn't have bought Sberbank. He should have bought X, or, wow, what a, 2 years from now, what a great decision Sberbank was. So I think there's something to be learned. I mean, again, imagine if you could go into the window of what's going on at Berkshire Hathaway in the middle from the 1985 on, and to kind of see the internal way that decisions were made, and so on and so forth. So that's what I try to provide here. But yeah, you need to do your own research, make your own decisions. There's something called suitability. So what's right for me may not be right for you. With that said, happy investing. Take care. Ciao.